10-minute evaluation. What else do we need to add to it? Tato, if you're going to just do a quick and dirty, what else would you do before
The
you
only
kind of
other thing
wrap
I
up?
would say, this is just speaking from my own experience, and this will depend a little bit on the type of business, is similar to how you assign some sort of ballpark net for your debt, probably do the same for either capital injection or just common oh shits, right?
Mm-hmm.
A lot of times, no matter how experienced you are, you don't know what you don't know. And stuff happens, regardless of how confident you are. Maybe a key employee quits and they have to be immediately replaced. And so you need to either offer that new person a higher salary due to inflation, or you need to hire a recruiter, or, whatever. In my case,
Welcome to the Exceptional Companies Podcast, a podcast for purpose-led entrepreneurs looking to master the art of buying, selling, or optimizing small businesses. Your host, Chris Seegers, founder of Exceptional Companies and author of Selling Main Street, has over a decade of experience starting, buying, and leading successful businesses. He's here to guide you through the complex world of business transactions and growth. Each week, we dive deep with actionable insights, expert interviews, and real-world strategies to activate and equip you to live exceptionally and build exceptional businesses. Now, let's dive into today's episode. Here's your host, Chris Seegers.
Welcome to the Exceptional Business Podcast, hosted by yours truly, Chris Seegers, where we explore how to buy, sell, and optimize your small business. Tato, welcome back to the show. We did a jam session last week and it was awesome.
yes.
And I'm sure our audience is going to love it. So we wanted to do another one because a topic came out of that discussion, which was, as you're buying a small business, how do you move through acquisition mode quickly? How do you remove roadblocks? And we had talked about a 10-minute due diligence. And this is going to be real, like quick and dirty. I'm not going to show like some professional slideshow. We're just going to chat through it. So I wanted to also make the point, as I was prepping for this podcast, if you're a seller, it's kind of the exact same thing, right? So I don't want a seller or somebody who owns a business to be thinking, oh, this is just for buyers. I should shut off the podcast right now, because this is how you prep. This is how your buyers are going to think when they acquire your business. So this is how you.
This is like, opposing team MO, which is super valuable.
100%. Okay. So we've looked at hundreds, maybe thousands of businesses. And through that process, we got really frustrated because the amount and quality of businesses was too low. The amount was too low. We weren't seeing enough businesses generally. But then when we got the hundreds into our funnel, the quality ended up being really poor. Out of 100, you might look at 10 somewhat seriously. And then out of that 10, maybe you could offer on half of them. Tato, what was your experience as you think through buying businesses? What advice before I dig into it, just how did you think about buying a business? I know you thought through buying real estate and kind of mitigated your downside risk, but as you think about buying businesses, where would you start?
Yeah, definitely. So kind of like what we talked about in the last episode, but it really depends on like where you're at and what you want, right? Based on your own personal circumstance. But there are, of course, some common things that every single business is going to either have or not have. In my case, my business was incredibly asset heavy. In fact, I only purchased the assets, and the assets outside of, some heavy machinery was the real estate, right? That happened to be my strength, underwriting real estate. And so with that said, there was still plenty of financial documentation around the business, right? Balance sheet, P&L, et cetera. I had absolutely no experience whatsoever interpreting those documents, like none whatsoever. And I didn't really seek anyone else with experience out. And I absolutely wish that I had. Ultimately, in my situation, it's worked out because, again, like I really mitigated my downside risk in a lot of ways. But I looked at a financial statement literally today for a company. And I looked at it with somebody who understood it much better than I. And the things that he was picking out, I was taking notes on, right? So don't feel like you need to be an accountant going into buying a business. Don't feel like, oh my gosh, I don't know how to read this, and so therefore I'm going to get wildly screwed over. No, but ask for help.
Yeah, 100%. And everything we talk about in the show is very common sense, right? Because there are professionals. So there's a great book called Who Not How. That is like my favorite thing. So as you get a company under LOI and you're actually going to put your own money down and you head towards the purchase and sale agreement, if you're not comfortable with financial statements and financial analyzation, Is that even a word? I don't even know if that word. Analysis. There you go.
Analysis.
Analysis. I would absolutely bring in a professional, but you don't need to get to that point until you're pretty far down the road. So I'm going to
No,
back up.
agreed. Yeah,
So,
find somebody who's looked at a few more than you have and sit down with them. Buy them lunch, sit down with them, and do a basic review.
yep, 100%. So when we started looking, and I think we talked about this on a previous show, we scraped all the listings nationwide. And then we said, okay, what are the things that magnetize us to or from, right? So we didn't want restaurants. We didn't want liquor stores. I was not for asset heavy businesses, which you and I are different in that for a variety of reasons. And so I pulled in a list of businesses, okay? And let's just say for the sake of discussion, it's 100 businesses. Then you want to build a buyer profile so you look professional, and we can help with that. And Tato, you've done that where when you send this to a broker, A&D advisor, they say, hey, this person knows what they're doing, at least to a basic level. They've spent some time. They're worth my time. So then you can sign an NDA and you can start getting the data. And this is the 10-minute review. This is the point in time where you do your 10-minute review. And this is what that would look like. And I'm just going to give high level and then we can chat about it. I would ask for 5 years of P&Ls, tax returns, balance sheets, any sort of equipment list. And then if they have it, a client list and an employee list. That's it. This is all you need. And here's why. And honestly, I wouldn't even look at the client list and the employee list until I've gone through the financials. Look at tons of these. I'm not some savant when it comes to finance. I've got a great team and they do the analysis by and large, but I just looked at a lot of these. So very quickly, when you pull that 5 years of P&Ls and account and your tax returns, you want to look for patterns. And everybody, the more you look at things, the better your brain gets at pattern recognition, right? So I would pull these financials and I would look for a few things. Number one is consistency, right? Especially with COVID. How consistent was this business? If they were, for sake of discussion, they were $1 million revenue, 200K SDE, and then all of a sudden they were 400,000 SDE, and then now they're 180, and then they're heading to 120. That's something immediately I'm like, either, hey, this is in my buy box and I want to do a turnaround, or this is not, and I'm passing. The second is get into the tax returns and compare them against the P&Ls. And what I'm looking for is this owner a liar? Is this owner a liar? Right? And a lot of them are. I don't want to buy a business from a liar or somebody who's doing things that are unethical or illegal. That's just one of my metrics. That doesn't have to be one of your metrics. But I want to go through this and say, this is an actual business. This is not somebody just like running every possible personal thing through the business. This is an actual business. Now they have reasonable things that they're writing off, right? Like there are totally reasonable things that you can write off. You should ask your accountant about it, but oftentimes it's your mileage and your cell phone and just different things like that. But we looked at one business where the person was writing their kids' college tuition off through the business. And I was like, okay, that's a problem. We looked at one where the person was writing like half of their lifestyle expenses off through the business. Now, if that person is very open with you and says, hey, my accountant said this was okay, here's why, et cetera, and they have a background for it, I'm still a little worried that's a yellow flag, but I'm less worried than if the person's like, yeah, whatever, man, like screw the government. Because at some point in time, you're buying the integrity of the business, who is the integrity of that owner. So I'm going to stop there. Like I would go take those 5 years P&Ls, look for consistency and look for kind of, is this person someone of high integrity or not? What else would you pick out if you're doing a quick and dirty evaluation?
Yeah, I couldn't agree more. You touched on this a little bit with regard to lifestyle, but like ad backs, right? Sellers are going to, I shouldn't speak for all of them, but some sellers will definitely try to inflate that to make the business look more attractive. I fell into that trap a little bit during my acquisition and I just really didn't know better. The ad backs were heavy and, it was a selling point for him. Specific to COVID, like you mentioned, PPP was a big, my seller got a bunch of stimulus and that's completely irrelevant in your financial underwriting.
Yeah. EIDL, PPP, go through the tax returns, get like, on their P&L, they may not have it, but it'll be on the tax return. Make sure you find that because it could have been a PPP loan that was $100,000. EIDL, like there's all kinds of government benefits that were coming out that literally have nothing to do with the health of the business. So immediately you're going to pull that out.
For sure. A good tactical example is the P&L I looked at this morning, or actually was the financial statement. This is just like common sense math, right? Like you don't have to be good at math to see that he said that his net takeaway annually was around 300 to 400,000. Yet from 21 to 22, he added $3 million to his bank account. Like the numbers are right there. So common sense tells me that that is far from adding up. So that's an immediate question to the broker or whomever. I'm sorry, where did $2.5 million come from? I'm so confused, right?
Yeah,
Which he, in this
100%.
case, couldn't speak to.
Yeah, 100%. So pattern recognition, the 10-minute review is like, is this thing feel right or not right? As you start looking at more, trust your guts. The second is take the 5 years of tax returns. Number one, I don't evaluate a business at all on P&Ls. 0, 0, 0. Like I look at them briefly to see if there's other weird patterns or things that are on there that I should ask questions on. But everything I do is tax returns. Everything. So if the guy's like, yeah, I'm not going to give you 5 years tax returns, I say, thank you. Have a great day. I'm passing on this deal, because the tax returns are exactly what they got paid. Right. And now there can be tax fraud and tax evasion, but there's very few people that are going to do that. The P&Ls,
Right.
man, your accountant can manipulate a lot of things. You can be doing accrual versus cash-based accounting. There's just a lot of ways that you can change things. Okay. So you kind of do this quick and dirty. Then the next thing I would do is take that net cash flow, add back, have like a reasonable amount of add backs, right? Like, hey, I need to hire this person. It's going to be $50,000. This piece that he said was an add back is not correct, so I'm deleting that out. And then take that 5-year average and just see, is this worth my time? If you're like, I need an SDE of 250,000 minimum, then if it's a 150 SDE, move on. Like, do not spend the time. Don't be thinking, well, what if I did this? What if I added this? What if I did marketing and advertising? Move on. It doesn't fit your buy box. I see so many folks that are like, hey, I'm looking at this deal and it's 100 SDE. I'm like, that's not going to pay your bills.
Yeah.
Like, move on. Like, unless there's something like Tato where it's a real estate play, it's like you got to stick to whatever you are.
Yep. One line, I totally agree about, like, don't get caught up in, well, there's going to be a marketing spend. There's going to be a, this and that. I would get clear on some sort of ballpark fixed monthly number of what your debt is going to be, because more often than not, those businesses are paid off or the assets are paid off. And so they're not carrying debt. And so naturally their numbers are going to look a lot more attractive. Well, unless you're coming in and it's a cash deal, no matter what, you're going to have debt. So you need to get comfortable with associating some monthly or annual nut and just immediately take that off, that SD.
You're reading my mind. That was literally where I was going next. 100%.
Perfect.
Okay. So you take whatever that number is and you're like, hey, this is generally what, where I'm going to be, what I need SDE wise or EBITDA wise, whatever your calculation is. Then your next thing, you should just have a super basic financial calculator, and you can do it in a spreadsheet. And it could just be like, here's the purchase price, here's the add backs, here's the total, and then just a basic debt calculator. The debt generally is going to be 40 to 50% of the total net, right? Now, SDE is different than EBITDA, right? So if there's all these add backs and all these other benefits, then that's going to change. But if you go in and you're like, hey, I need 250 SDE, and you're like, well, my debt cost is actually going to be, let's say for sake of discussion, $100,000 a year. I've got 150,000 left over. You might all of a sudden be like, well, actually, I really need to go higher. I need to buy a 500,000 SDE, which I always prefer. If you can go bigger. Now there's pros and cons, but that's always my preference. You might immediately say, I need to go $500,000. My debt cost is 200 or 250, whatever, depending on the purchase price and terms. And then all of a sudden you've got 250 left over to work with. That feels a lot better than buying a job where you're like, I'm only making $70,000. I was already making 150,000 in my job, and this is way more work. Now, your net benefit is a calculation. We have this tool called the net benefit calculation. It's just a PDF where it takes all the benefits of buying a business. But at the end of the day, I want you to buy this based on cash flow, right? So if you take this, you look at all the financials and you're like, hey, they're consistent. Like this business we're about to buy has been 1.4 million EBITDA for 7 years. Just freaking beautiful. I love to see that kind of business because I'm like, great. Now I can calculate exactly what this is worth and what I'm going to pay you. But if it's here and there and there and up and down and up and down, they're going to want to pay you the last 2 years, which are probably their best years. I'm going to tell my buyer, if I'm repping the buyer and not the seller, hey, take a 5-year average and let's look at that, and take the worst year and say, hey, during the worst year, can you make this thing work? So that's kind of the next thing. So you go really quickly and you can just say like, well, this cash flow is not worth my time. We're going to meet with a potential sell side client tomorrow. And this is one of the first things I coach people on is, hey, if your business is worth 2 million bucks or whatever you think it is, I'm going to say, number one, where did that come from? Number two, I'm going to say, do you understand what the cost of debt is right now? Because debt, SBA debt is, prime plus 1.5 or 2%. Let's just say it's like 10 to 11%. Yep,
Yeah.
100%. So I'm going to just show them a basic calculator of if someone buys your business for $3 million, this is what it's going to cost. This is what I think the multiple is going to look like. And this is what the business can sustain. Because ultimately that seller in their legacy, they're like, I want this business to go on, right? And so if they try to sell at such a high price or terms that saddle that potential buyer with a business, that business can't actually afford that debt, then they're putting themselves in that buyer, and if they're undercarrying, in a really bad spot. So I like to get that out of the way up front and say like, hey guys, if the business can't sustain the debt, either it's not the right business or your purchase price is way too high. And so people generally make offers that are way too high and then try to retrade them. And most sellers are like, no, you told me 3 million, it's 3 million. Now I have it in my head. You're telling me now it's 2 million. I just lost $1 million. So what else, Tato, on that piece? Because I think that's really critical just to understand the basic cash flow.
Yeah, absolutely. I think that there's something to be said for knowing that in any deal, there's a ton of room for creativity. I think that's one of the really special things about small business acquisition versus real estate. You can get creative in real estate for sure, but it's kind of to a limited extent. I think that the amount of creative options are completely endless when it comes to SMB acquisition. With that said, don't let it play contrary to what we're talking about here, where like, you want to rip through quick due diligence so that you can underwrite as many deals as you can and like really flex that muscle. But I think if you come across something that's super interesting and for whatever reason you feel like, well, it's not quite right here or there, to the extent that you're willing to spend the time on this, it's worth at least maybe pursuing to a certain extent. Because like I said, like there's so much creativity to be had and you have no idea how motivated or not the seller is on their end, right? Some will just totally play you and then they'll ultimately, not come to closing because they weren't really serious. But a lot are serious. And for whatever reason, they need to get creative to get the deal done and get to the end of the table.
Yeah, 100%. I love that. So the caveat I would add is don't get creative until you've got a good deal. Does that make
fair
sense?
enough.
So what happens? No, what you said was exactly right. But what I've seen is buyers are like, oh, I've got this deal and like this, I'm going to do this and the owner's going to do that and we're going to do this. And I look at the deal and I'm like, this is a bad deal. The reason you're having to financially engineer this deal is it's a bad deal.
It's because it's a bad deal.
Now, but that doesn't mean, for example, this business we're looking at, we're getting really creative because the owner is like, hey, it's worth this. I'm willing to do this. And I'm like, this is an awesome deal. So we're going to go really slow. We're going to find a deal that works for them and for us and for our team. It's going to set it up for the next 20 years. And I'm willing to get creative on that side. And the bank will be too, because they're going to look at the financials and say, wow, we want to underwrite the debt for this. This is a great deal. And that's where the 10-minute review, it's kind of like 10-minute and 10-minute LOI. It's almost like that should be your, like speed to action, bias to action should be the deal when you're evaluating. So it's like, all right, you did your 10-minute review. You looked at it and you're like, yep, it's consistent cash flow. It meets my buy box. It covers the debt. Then you want to send an LOI quick, right? Like, you don't even know if the buyer is going to take or the seller is going to take your offer until you do. So let's say the business is listed for $1 million and you're like, man, I love this business. It's consistent. It's right in my wheelhouse, fits the buy box. No, I can get it financed, but I really only want to pay 800,000. And you're like, that's what I want to pay for it. That's what I'm willing to walk away at. Send that number quick, right? Yeah. Like we sent so many offers. Sometimes they were just in emails. Don't even draft an LOI. You can just email the broker or advisor and say, hey, we're at 800,000 based on what this looks like in our 10-minute evaluation. We'd love to put it under LOI and do due diligence, but we know we're far apart. If the seller isn't even willing to entertain that, then thank you so much. And if they change their mind, let me know. So I love that, Tato. It's just like that bias to action moving through it.
Also, I was just talking to somebody about this today. If ultimately, whether you get told no from the get-go or you get 3 months down the road in due diligence and ultimately it doesn't work out, so many of those deals come back around. So don't 100%. Don't be afraid to walk away from something, because you would be surprised how many times that person will come back knocking at your door.
And your number might be half. I mean, like, be totally comfortable with like, hey, these are the numbers that I love.
Yep.
This is the way we go in. I never fall in love with the deal. I'm like, hey,
Mhm.
this business we're looking at, what's a structure we would love? And then we come up with that number and that structure
Yeah.
and we say, this is it. And then we move
Yep.
on. If they're like, hey, no thanks. This business, we were supposed to close it in April. They said no. They thought it was worth more, and we had underwritten it and talked to the bank. They said, this is the deal structure we can actually write this debt for. We came back, they said no, and now they're back again. We could have closed last month. Now we're going to have another probably 90 days. And they're just like, look, you guys are great buyers for this business. We know
Hmm.
you're the right people for this business. We're willing to take a little bit of a haircut, not crazy. We're not being ruthless, but to get the deal done and get the bank happy with it, we're willing to drop the price to this. We had already moved forward. We've evaluated a ton of businesses in the
Hmm.
meantime, and also have continued to run our businesses. But I always kept that conversation open. Just be super like respectful. Hey, this just doesn't work for us. Your business is incredible. I'd love to buy this business, but this is the terms that I think will make it successful.
Yeah.
Call me if you ever change your mind. And like you
Yep.
said, a lot of them will change their minds.
Yep.
They're tired, they're ready to go. And if you're a qualified buyer that care about the business, they can tell you care, you're going to care about their employees and their clients, there's a good chance you're going to come back to them.
Couldn't agree more.
I love it.
Do you like what you hear so far? Make sure you never miss an episode by clicking the subscribe button now and check out our website, www.excoadvisors.com. This podcast is made possible by listeners like you. Thank you for your support. Now, back to the show.
Okay. So 10-minute evaluation. What else do we need to add to it? Tato, if you're going to just do a quick and dirty, what else would you do before
The
you
only other thing I
drafted?
would say, this is just speaking from my own experience, and this will depend a little bit on the type of business, is similar to how you assign some sort of ballpark net for your debt, probably do the same for either capital injection or just common oh shits, right?
Mm-hmm.
A lot of times, no matter how experienced you are, there's like, you don't know what you don't know. And stuff happens, regardless of how confident you are. Maybe a key employee quits and they have to be immediately replaced. And so you need to either, offer that new person a higher salary due to inflation, or you need to hire a recruiter, or, whatever. In my case, again, like I, own a manufacturing company, and I completely overlooked how little the machinery was maintained by the owner,
Mm-hmm.
right? Like most of these
100%.
owners are a little bit preemptive, right? Like my owner knew, or my seller rather, knew that in the next couple of years he was going to sell. Well, of course, like they'll just turn a blind eye at, any type of like proactive maintenance that they would maybe have done, over the last decade. Well, now they know they're going to sell, right? So why would I maintenance the forklift? It's not going to be my problem in 12 months. And now it's your
Yeah.
problem.
100%. In fact, I was talking to a gentleman in my mastermind. He had just bought a manufacturing company. And I would call him the GM. I mean, it's a small company, but he was running the whole deal. 3 months in, or maybe it was a little longer, 6 months in, he came to my buddy who was the new owner and said, hey, just so you know, the owner really kind of guilted me into staying. I was planning on retiring last year, and I really want to retire in like a few months. Now, I want to make
Mm-hmm.
sure this is taken care of. But the owner had told my friend, the buyer, hey, this guy's going to stay for a few years and he's going to make a great transition. So assume the worst and set some margin.
Yes.
Going back to that point, that's an awesome point. What do you think a good number is? Or do you think you would recommend a percentage of the total deal structure? Like,
Yeah,
how would you
I
think
think
about
it
that?
I think it really depends on the type of business, right? If it's asset or assetless, but I think generally speaking, assigning some sort of like quasi doomsday percentage
Mm-hmm.
to the number, the SDE, or maybe the top line revenue or something is safe.
Yeah, for sure. I would take a look at your revenue, your
Hmm.
expenses, your burn. So like, hey, what if you weren't able to pull in any of your revenue, your accounts receivable for 2 months or 3 months or
Hmm.
6 months, and then really come up with that emergency fund.
And like a good like quick check, and I can't say that I did this, but I should have. Look at, if you have the last 5 years of financials, or even if you have more than that, great. What 5 years ago, what was that maintenance number, right? Again,
Mm-hmm.
it depends on the business, but if it has assets, what was that maintenance number? Has it decreased?
Mm-hmm.
Well, I can guarantee you the machinery is not getting better, you know?
Yeah,
There,
100%.
so if for whatever reason, like key numbers like that are decreasing, that could, not always, but could be an indication of neglect. And so really try to drill into that and
Yeah,
assume that they're
absolutely.
going to lie to you.
Sim, and when I say lie, I would just say like I don't even think it's misrepresent. It's just people love their business.
Yeah.
They might not say some things that
Yeah.
should be said. They might, not tell you the
Hmm.
things because they want to get the deal done. And they're
Yeah,
not, most
absolutely.
people are not malicious. Hopefully you find that out in the due
Hmm.
diligence. But there are going to be things that one of the businesses we bought, it was the same thing. It was like, oh, actually, you need $15,000 worth of computers to get up to code for
Mm,
your insurance provider or whatever it
yeah.
was. And it's like, okay, you could have easily told me that, but
Yep.
then we would have factored that into the purchase price. So
Mhm.
emergency fund, here's another thing I'll point out on that. So most folks bake in some sort of line of credit into their closing, which I think is reasonable.
Mhm.
If at all possible, try not to use that. It's
Yeah,
super expensive.
agreed.
So right now, like your line of credit is cost of capital is really high. So if you can put, and this is what we've done with a lot of our businesses, if you could take X amount of cash, let's just say you're like, hey, I need $50,000 for an emergency fund for this business. Put it in a high yield savings account, make 5.5% or 6% or whatever the best you can do is. Have that as your backup. You're making a little bit of money on it, hopefully beating inflation. And then if you draw it down, you draw it down. But if not,
Mhm.
you're good to go. But if you got to draw your line of credit down, they're going to charge you maybe same amount, 11%, probably 8 to 11%. So you're going to
Mhm.
get charged on that. So I would try to, if you're able to have some cash reserves. The other thing that we often do or recommend is ask for a certain amount of your accounts receivable in
Yes,
the first
I
60
was gonna
days.
say that.
So it could
Yep.
be, hey, I want you to give me 100 grand of the first accounts receivable, and that's going into the bank account to help continue to keep the
Yep.
business going because that revenue is going to be lumpy for most
Yep.
businesses.
I thought of two more things. One, I bought a business that specifically due to COVID experienced a huge spike in growth because we're
Mm-hmm.
in the building industry. And while that has been fantastic for me and I've really ridden that growth wave and been successful with it, I absolutely did not translate that to staff growth, right? You're like, awesome, this business is growing, da da da, like they're doubling top line every year. That's all amazing. Assume that you're going to have to continuously hire and take that into account. I did not at all. I had to hire like 6 people in the matter of a few months. And that, I mean, it totally wiped out my cash flow. And I just didn't anticipate that.
I love it.
Yeah.
Okay, the 10-minute due diligence, and then you could probably do 10 minutes to LOI or email offer. What
Yep.
else should we cover? What else are our listeners thinking about, Tato?
I had just thought of a second thing and now it ran out of my brain. Growth, and whether you're buying a business that makes something, right? Like we manufacture something from raw material, or you buy some sort of sales business that's inventory related.
Mm-hmm.
Something that we did not clearly define at closing that I ended up being on the losing end of, purely out of naivete, was raw material. I just assumed that at the closing table, I took all the contents inside the building.
Mm-hmm.
Now, this again, like I had no confidence, hadn't flexed this muscle. I'd be a lot wiser now, but I just was like, oh, oops, okay, my bad. And after closing, I pulled my checkbook out that day and wrote him a check for all the raw materials left in the business because he was like, well, I paid for those, but I bought the business and all of its contents, right? So
Yeah.
had we brought that back to the lawyers, I don't know which way it would have gone, but bottom line, it was a learning, I way after the fact, I was like, oh my gosh, like how did I not even just stop and call my advisor, right? There
Yeah.
was never even a
100%.
call. I was just like,
Yeah, for
oh, okay,
sure.
my fault. Wrote him a check for $15,000. That's a substantial amount of money that I ended up really needing.
Yeah, absolutely. And that's where, like, as you put together your purchase and sale agreement,
Yep.
go through every one of those with the
Everything.
seller and with your attorney and just say, hey, I want to make sure we're on the same page here. We get lock, stock, and barrel, or hey, I'm paying you $30,000 for inventory and 10
Mm-hmm.
for FF&E. And, like make sure you capture all of those. And also talk to your accountant about the tax benefits of all of that, right? Because you're going to have to pay taxes on certain things and not
Yeah.
taxes on certain things. You're going to have basis established for your business. We've in the past made big mistakes on overvaluing FF&E, and then we've got to pay personal property taxes when we
Yeah.
close. And I'm like, dang it, this is actually worth less than that.
Yep.
and it was kind of a bone for the seller. So there's just
Yep.
a ton of things that your accountant or your attorney or your advisor can help you with. And they're big money, right? Like it could be 2,000 or it could be 100,000. So,
Mm-hmm.
and don't be afraid. I think too, Tato, like, you know, you and I have both done this where we get to the point and we're like, I feel like I should push back on this. And maybe
Mm-hmm.
we don't be afraid to push back.
Agreed. I could
And just
not agree
say
more.
like, hey, you know, this is not what I believe was contemplated. Let me talk to my attorney and let me look at the purchase and sale agreement. Yep. Let me confirm it and I'll just get back to you and we'll come up with something. Because you can always say, you know what, I'm going to pay you even though it doesn't say it. I want to get this deal done. Or, hey, let's split it or whatever. But yeah, for sure. I love it. Okay, cool. Well, the 10-minute valuation, use it. Don't spend too much time on it. And then just look at as many deals you can. Yep. Make really good offers that you love. Remember the debt cost and all the other things. And we'll put a bunch of this in the show notes. And we'll cut some of these into smaller clips too. Tato, what else should we close with to help our listeners?
Everything in business and in life, honestly, in my opinion, is just reps, reps, reps. I've been investing in real estate almost 6 years now. I own over a dozen rental properties. And do you know what I'm going to do after we're done here? I'm going to get in my car and I'm going to drive for dollars.
I love it.
I do it as many days as I can. It is so basic, but, and you know, I'm sure people are like, oh my God, I can't believe you still do that. You have so many years under your belt. Like reps, reps, reps.
Stay humble, 100%. And that's what we talk to our team a lot about, the 10,000 hour rule, like 10,000 hours for mastery. But the thing is, you can get those 10,000 hours a lot quicker than other people, right? So it's like, you want to do a 10-minute review of a business, look at 100 of them. You want to get to the point where you're like, I can do a 2-minute valuation of this business. Look at 1,000. Right? Like this is, you want to evaluate an employee and be able to understand when you're hiring somebody, you've gone through your whole thing and just understand, like, is this person going to be a fit or not? Your gut. Interview 100 employees. And I'll tell you what, I'm pretty dang good at understanding who's going to be a fit or not. So I love that. And don't be, like you said, don't ever lose your humility. Like we look at businesses almost every day and real estate almost every day. And we're constantly telling people, hey, this is what we do. We buy businesses, we buy real estate. This is how we help people. So talk to somebody at the checkout counter if you have to.
For sure. I mean, I think it's humility. Absolutely. And it's also like, why would you reinvent the wheel? Like I've gotten how many amazing deals through Driving for Dollars, using my Driving for Dollars app and just like consistently sending mail. Why would I deviate to anything else? Like, sure, you can try other things in tandem. I'm not saying like, don't be inventive, but if looking at businesses and underwriting them and writing LOIs is what works and has worked for everyone in the past and will for a lot of people in the future. It's like, why look for some other way when like, that's the way.
Yeah, 100%. Tato, it's always a pleasure. We're going to do a ton more of these. You're just going to be a recurring guest. Whenever we come up with something that we think our listeners could get some value from, or a question that somebody has brought up, either a buyer or seller in our coffees or conversations, we're going to bring it up and chat through it. Thank you so much for being on the show. Have an awesome day.
Thank you.
Thanks for joining us this week on the Exceptional Companies Podcast. Make sure to subscribe to the show on iTunes, Spotify, YouTube, or via RSS so you'll never miss a show. While you're at it, if you found value in this show, we'd appreciate a rating on iTunes, or if you'd simply tell a friend about the show, that would help us out too. If you like this show, please reach out through our website, www.excoadvisors.com, for free tools to order a copy of Selling Main Street, or to sign up for our free webinar on how to sell your Main Street business.